Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, January 30th, 5:41 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we're in an uptrend, a cautious uptrend, trying to come off the bottom, back above the 200-day moving average on all of the indexes until the NASDAQ 100 broke back below it today. Sort of a normal pullback. We'll dive into it today, although leaders were hit hard and it felt like a pretty vicious sell-off, but we'll dive deep and you'll get my take on it by the end of the video. Let's check over here on the trend gauge. Leaders still bullish. Not a single one broke the 21-day moving average today. 5 of them broke below the 80 MA. So still plenty of strength there. Short term, all 5 of the major indexes are trending above their 21-day exponential moving average. Medium term, all 5 above the 50-day moving average. Long term, as I said, all 4, with the exception of the NASDAQ 100, are above the 200-day moving average. NASDAQ gave us 2 closes above the 200 to close last week, and now today pulled back. It had been the leader after this most recent pullback, and so it gave back the most today. But again, still a normal pullback. All pullbacks have to be taken in context of what has recently happened and what happened to the big leaders and the stocks that drove the most recent move higher. So for that, we're showing neutral. Also, the slopes of the lines, 2 of them are flat, but 3 of them still trending lower. So we don't get to full bullish until we get the slope of the 200-day moving average turning back higher and give us some confidence that a bottom, at least a short-term bottom, has been put in. So what happened today? We gapped down in the morning, weak all overnight, gapped down 0.7%, tried to rally, sold off, and then just really lower highs and lower lows in a tight range all day. There was no panic. It was just a feeling of taking some profits after the recent run up in anticipation of what the Fed is going to discuss on Wednesday. So leaders hit on a pullback day, NASDAQ 100 below the 200. Here were the numbers. Uh, I'm gauging my statement leaders hit based on what the 2121 did. The average stock down 2.71% in the 21 over 21. G6 minus 2.03, S&P down 1.3, NASDAQ 100 down 2, Dow down 0.8, mid caps down 1.1, Russell down 1.35. Global diversified 60/40 stock and bond down 0.82%. Emerging markets got hit pretty hard, down 2%. China took it on the chin overnight. In-house GROTECTION down 1.34%. We'll go through the focus list from the tail of the tape and all the indexes. And let's get into that right now. First of all, what do we do at Revere? We are active managers. We gauge the strength of the overall market and leadership across 3 time frames. Those 3 time frames were shown on the prior screen in the trend gauge. And when we're trending above moving averages, we put more money to work. Ideally, we're trending above all 3 of them, and all 3 are configured shorter term 21, above intermediate term 50, and above long term 200. We're close to that right now. And we are coming off of a bottoming base that we put in during December. You can see the move up here. Today's pullback 1.29% on the S&P. In context, a normal pullback. Nobody likes losing money. I certainly don't. But we're getting ready to, January is going to close positive, barring a huge sell-off tomorrow. And that's going to put us at 3 for 3, the trifecta. That's the signal for whether or not the year is going to be bullish. If you have a positive Santa Claus rally, a positive first 5 days of January, and a positive close at the end of January, never before, and I hate to say that word, never before, because you're just setting yourself up for it, but never before has the market not finished positive for that year when all 3 of those boxes were checked. So let's look at a 5-minute chart, first of all, on the S&P 500. And first of all, why do we actively manage and why do we protect capital? I still have to show this picture because if you're approaching retirement, you can't afford to get hit with one of these huge bear market drawdowns. Top to bottom last year, the market fell 27.5%. Our loss was less than half of that. Easy to recover from a 12% loss. You only need a little over 13 to get back to even. If you lose 27, you need 38% to get back to even. That's just the way the math works out. When we went into the bear, we never knew how long it was going to go. We do know that normally when you break the black line, the 200-day moving average, at that point you're normally down about 12%. And then anything more than that is subtract all of these numbers that you see here by 12, and that's the further drawdown that we attempt to avoid here at Revere. Severe, the average of them is down 44.5%. You need 80% to get back to even. This is a portfolio destroyer if you don't protect your capital. And that is why our number one job is protecting the downside at Revere, and then the returns take care of themselves when the market gets back to a healthy posture. And it has been considered healthy since we had multiple closes above the 200-day moving average about a week and a half ago. It's perfectly inclined to pull back. Markets don't go up in a straight line. What we do when they pull back is we gauge the strength of the pullback. And just looking here at 5 minutes, you can see 2.5 days of the market climbing higher. Got a little too extended, harsh pullback here at the end of Friday. Gap down, tried to rally. Here's the pullback, and then just lower lows and lower highs into the close. The key level that I've been mentioning is 4,007. That's a big fib area. There's also another one at 39.99. I'm not overly concerned unless we break those levels. If you look at a 60-minute chart, you can see here, here's the false, or here is the scare a week and a half ago. We rallied right through it, gap down. Here's 3 straight up days, a normal pullback. You can see here's the 4,000 line here. This is what we want to stay above, 39.99 to 4,007. Our pullback was completely in line with Thursday's pullback. We that low was 39.80. We didn't even reach that. So if you measure from the low on 125 or the low on 119 to the high, we're completely within the realm of normal pullbacks for that day. The 50% pullback from here would be around 40.12. There's multiple levels in here between 40.12 and 40.18. And this pullback is normal. If we have another one like today, I'll get a little bit more concerned, but we'll deal with that tomorrow. We've got our stops for everything in place. We sold something, took a little profit on it today, took 2 small positions. We're down 1% on one of them, 3% on another during the pullback when it looked like the bottom was in, but we sold off a little bit more. You can see we're oversold on the 60-minute stochastic here. So uh, we can stay that way for 3 or 4 days, but we clearly don't want to. To me, what I'm seeing is just people taking profits ahead of the Fed on Wednesday, and they're getting ahead of possibly other sales that might take place. So that's what I see on the S&P 500. Let's go to the NASDAQ 100. You can see the 2 closes above the 200. It's still declining, and we did close below it by 0.7%. You can see the stochastic rolling over. This is a common theme that you're seeing across all 5 of the indexes, and it is something that we're watching. We could just bounce around near overbought the way we did back here or back here, or it could be more severe like it was here, here, and here. All we do is weigh the evidence, watch how the leaders are acting, watch how the indexes are acting, put our stops in place, and then let the market unfold and we'll react to it. Dow Jones Industrial Average pulled back the least today, so showing relative strength, still above its 21 and 50-day moving averages that are also stacked right near the 80 MA there, still comfortably ahead of its 200-day moving average, which is 4.2% lower, and very close to flattening out. Mid caps had been leading. This is the profit that we took today, a plus 1.5. of the risk that we put up when we took it. Um, basically, mid caps, you can see by the flat line here, basically just in line with the S&P 500 since we took this position. We were up around a little over 3% on it. It was a 5% position. So we just locked the profit in to reduce risk approaching the Fed, trying to keep our exposure to the market in line with the overall risk of the S&P 500. So just taking a little bit off after a nice run up on mid caps, and this looks fine, still above the 80 MA. And now small caps IWM sitting right on the 80 MA, down 1.3%. Same setup with the stochastic there, sitting on the 80 MA. So let's look at 60-minute charts very quickly of all these. And you can see by this that still these are normal pullbacks. The first thing that would make it abnormal would be for the small caps a break below this 186 level, and then the two recent lows on the pullbacks that were made. So those are the levels that we're measuring against. And on the 60-minute chart, this again just looks completely normal, the same way it does on the daily chart. Here's the S&P 500 or the Nasdaq 100. You can see how much higher up in the pattern this is because this has been the stronger index, sitting right on 290. Good spot for it there. Next level down. It is below, and these charts, I like to look at these charts because it takes all the moving averages off and it's just pure price levels. But the next levels that we're looking down are here at 282 and then down here at 270. If we break these, we'll have not exponentially, we'll have significantly less exposure to the market. But again, remember, we just had this big gap down on Wednesday, recovered immediately to the highs, 2 more days up, and a pullback. We haven't retraced half of that. As long as we stay above that 50% retracement level, it's a normal pullback, no matter how difficult it might have felt to people looking at your account balance. Here's the Dow, a little bit weaker, didn't go up as much. 33,500 is the key level here for the Dow. And those two levels, those two pullback levels, because of how weak this has been lately, are in this big base that the other indexes built but moved out of while the Dow lagged. Let's bring up the S&P and look at that one more time. So here's the base. These pullbacks were above it. These were the levels that we were looking at last time we pulled back here. As long as we held above this level, you got to give the market the benefit of the doubt. No time for panic selling unless your stock is down 15% on massive volume. That's a whole different story. But for now and for everything that we own, it was normal pullbacks today. No excessive volume except for one of the positions that we own, and we'll go over everything as we always do in the tail of the tape. Let's go to a couple more indexes here. First, we'll switch to the VIX. VIX had a spike today, but stopped going higher when it ran into this, again, the declining 21-day exponential moving average. It's been hanging around between 18 and 2021 over the last 2 weeks. Normal spike in the VIX today. It's if we get above this 50-day moving average at 21, 25, that we would start being concerned because that has really controlled the pullback the entire time. So another update tomorrow of 8% on the VIX will definitely get our attention. And you can see it's coming off oversold. We're aware of this. Will it come off and shoot higher? We don't know. Again, we're just weighing the evidence and keeping our exposure even with the same risk that the overall market has. Dollar didn't help today. It was up 0.36% and above the 80 MA for the first time in about 3 weeks. And it did trend higher today as the market got weaker. So you can see the dollar trending higher, market trending lower. This inverse correlation is still in effect. Strong dollar, weak market. Let's flip to bonds. Bond prices down across the board today. That means yields higher. Bond ranges have been very tight over the last week and a half. Here you can see us sitting on the 200-day moving average, rolling over on the indexes. The Fed and what they say is going to have a big impact on these charts come 2 o'clock Wednesday afternoon. There's the broad bond index. Here's the corporate bond index. Again, slight pullback. Here's junk bonds, JNK down. Very similar pattern on all of them. and then TLT, the 30-year long-term. The only one that has been unable to get above the 200-day moving average, but it's sitting on the 21. Similar stochastic setup for all of them, and if bond prices were down, that means the bond yields should be higher. Here's the 10-year TNX up by 1%, 0TYX, the 30-year up 0.74%, hanging on this downtrend line. That is the 21-day moving average. If the dollar was up, you'd expect gold and silver stocks to be down. Gold was down. This is the third straight pullback in a tight range for gold. Broke below the ADMA, and the stochastic is rolling over. But the last several times the stochastic rolled over, it didn't come down further than 60. We're keeping our eye on it. Maybe it'll pull back, maybe it'll settle. Again, the dollar and the reaction to the Fed is going to have a lot to do with this on Wednesday at 2 o'clock Eastern time. Silver down barely today, sitting on the 21-day exponential moving average. Gold and silver stocks outperformed for a while, ended up down 1.45% today, still above the 21-day exponential moving average, though. Let's check Bitcoin very quickly. Down 2% today, still in a tight range since it had that breakout 2 weeks ago. So those are the major indexes. Let's get to the tail of the tape and then some individual names. Let's see what's important to point out here. A little bit of news. Israel did a drone strike on Iran. Uh, that's not going to settle the markets. And 20% of the S&P 500 report earnings this week. So these earnings and the reaction to them are going to go a long way toward what the proper multiple should be on the market, the proper number of dollars, and what the PE is going to be for the market. And we'll just see how the reaction plays out. Like I said, we're keeping our risk no more than in line with the market. So the day count went from 4 out of 6 to down 1, closed right on the ADMA, 7 days above the 21 EMA, 16 days since the follow-through day on January 6th. And of course, Wednesday, the big FOMC day. As far as earnings go, the big one we're watching is Meta after hours on Tuesday. And then Thursday will be some fireworks with Apple, Amazon, and Google all reporting after hours on Thursday. Expectations positive as long as we stayed above 2007. Harsh pullback, but we didn't even touch 2007. Did break below this 40-40 level, though, that we would have preferred not to. Support resistance level 2, and also the 200-day moving average, which is support resistance level 2 on the NASDAQ 100. Here's the action. As I said, lower low, lower high, tight range most of the day. The point and the percent give back, a little bit tough to handle, but normal within context. And the selling was broad. Dollar up, bond yields up, gold and silver outperformed, but were weak, along with aerospace, financials, basic materials, and utilities. Only staples, the only positive sector out of the 12 that make up the S&P 500. On the weak side, semiconductors, K-Web, emerging markets, energy, the 3 tech sectors, biotech, and solar. Here's what we own in-house, along with some other charts that we're going to look at. What we did today, bought 1% Bros, 1% AEHR, sold 5% MDY. We came in with 1.08 risk versus the S&P. That's what we're going out with. Bottom line, leaders hit on a harsh but normal pullback, but the NASDAQ 100 did break below the 200-day moving average. So for now, this 4100 resistance is very clearly intact. So we approached it and pulled back on 127, similar to the way we did on 1213, and then a couple weeks before that was where the high was set in the first place, which was on December 1st. You can see the comments. Here is this multiple short-term Fibonacci's in the ADMA 4015 to 4022. This is the range that we closed in today, and this is really the range that we want to hold. Right below that is 4007, then 3999, then we get down to the 21 EMA at 3971. So we'll look at some individual names now, starting with the portfolio. Bros, This showed some strength last week, and some positive comments that I read about it on coming out of a conference and their growth prospects. That took it above the 200 on uh, above average volume last week. It was strong all day today and gave it up into the close, ending up down 1.16%. We've got a tight stop on this. It should hold the 200-day moving average. That was our first buy. The second one is AEHR. We sold out of this at 34 when it was extended 4 times above its 21-day moving average back on January 23rd. Pulled back below 34 today and bounced at the 8. We took that 1% position back in. We're now 1.5, closer to only 1.5 ATR above the 21, so a much um, reasonable spot for risk from a risk reward perspective to get back in. And then, as I mentioned, we sold MDY. So let's do some technical analysis now on the rest of the holdings that we have. XBI, biotech. Uh, Basically 7 days up, 1 day down. That 1 day down did give up about half of those gains though. But you can see here the breakout level is 84-ish, was pulled back and tested. 1, 2, 3, 4, 5, 6, 7 days up, 1 day down, a reasonable pullback. Um, no damage done there, oversold on the 60 minutes. So we're seeing a lot of them coming off of overbought on the 1 day or on the daily, but in oversold territory on the 60 minute. So that's biotech. Next up is gold stocks, GDX. Again, very oversold on the 60 minute. Here was the breakout level back here. Really, it's two levels, one here and then one here. So it can pull all the way back to 31 without any technical damage being done. Let's go to the daily chart. Did break the ADMA, but again, normal pullback in the context of the recent move, still above the 21-day moving average. Next up is OIH. It's outperformed for quite a while today, closed right on the ADMA, outperformed relative to the other oil stocks. So you can see the breakout here was on 305. We pulled back several times, 310 capped that. We're still above 320 on this, hitting oversold on the 60 minute. Those are the three ETFs that we own. Now onto the stocks. Boeing, normal pullback, break below the low of this earnings day would be a sell signal. So this had been a leader, time for it to consolidate as it's been consolidating basically all month. You can see that on the daily. Broke below the ADMA. Here's the 1 week, 2 week, 3+ week consolidation. Bounced at the 21 on earnings day. Lower volume pullback the last 2 days. Completely normal behavior on Boeing. Nothing wrong there. Next up, First Solar. This is a tough stock to hold. Uh, it's outperforming the rest of the solars, but some of them have gotten hit substantially. So 162 is the key level for this. You can see the breakout, how it pulled back and held it, pulled back again and held it. Let's go to the daily. We're still way above that area. Did break the ADMA today though, but still trending above the 21-day exponential moving average. Normal pullback for First Solar. Shopify, we just got into this late last week. This is a bad candle. This was that day when those upside and downside triggers were set by a software flaw on the exchanges. 3 strong days up on above average volume, 1 day pullback on below average volume. Let's go to the 60 minute. You can see the breakout here. 42, and then another breakout above 44. We're only at 47.19, very normal pullback for Shopify. Next up, Tesla. This one a little tougher because the high, this was really a major laggard during December and started to bottom late December into January, got back above the 21, then had its earnings. Big gap up on earnings, up 11%. The next day, up another 11%. So within that context, a normal pullback, heavy volume, 56%, but well below the prior 2 days, 109% the day before. And earnings day 65% above. Let's look at the 60-minute chart. Here's the gap from earnings. The low there's 153. That would be an absolute sell. We won't give it that much. But pulling back about a third of between the gap and the high of Friday. Again, normal pullback there. Bros, this is what we bought today. Here, 33 is the key level here. There's the breakout. Pulled back to the pivot 3 times, then broke above 36.20 here. Big shakeout down to that level, 36, early this morning, and then when it started to recover there, that's when we got back into it. I noticed it was on my list. Noticed the early shakeout, then strength, then it started pulling back. We got into it, I think 37.50-ish, actually about 37.70. So broke back below 37, didn't want to see that, but on the longer term 60-minute and daily chart, a completely normal pullback above the 200-day moving average. AEHR, the second one that we bought today, we already discussed this. Let's bring up a 60-minute. You can see the big breakout above 30 on this one. Then also the pullbacks to 33, it hasn't even made a lower low versus that most recent pullback, oversold on the 60-minute. And then finally, our last position, AI. This was massive volume on Friday, big move, up 18%. So within that context, a 8% pullback is normal, below average volume, although heavy volume. 878% on Friday, 378% today. The 200-day moving average is our drop dead area on that. So those are the ones that we own. Other stocks that were notable today, either for their strength or their weakness, CCJ continues to look good. Macy's was upgraded as their best idea by Goldman Sachs in the retail area. That's forming a nice cup and handle. GEHC reported earnings, nice volume off the ADMA, looking strong, higher highs, just making a stair step higher, two steps up, one step back. Here's your latest 2 steps up on GEHC. That looks good. Mobileye reported earnings, had a positive reaction. Double inside day since the earnings day. So volatility really shrinking on this, holding the ADMA 35 as a key level for that. PDD, now to the bad. All China stocks got hit today. PDD among one of the worst. This was a recent leader. There's its breakout. Let's go to the 60-minute chart for some context there, and you can see the breakout above 100 there, broke below 100, so it's back in this most recent base, which was above this breakout area, but never like to see that, and the volume was just average today, so compared to the breakout day, although we've given up all of the breakouts, so not a good sign there. Not really sure what's going on with all the China stocks getting hit today. Let's see, TMDX, recent leader. We were in this. We watched it take back off without us, but big sell off today, down 10%, below the 21-day moving average on 62% above average volume. This thing had been being accumulated every day into the close until today. Some people hit the exits on it. ON showed strength last week. Then just went a little too far, too fast, reverse negative on Friday, and then down 3.6% today, but volume lighter on the 2 pullback days. It has earnings in a week. And finally, Albemarle pulled back today. You saw this gap. Basically, it filled the gap. Strong stock. People just taking profits. The volume patterns on this are as good as can be expected over the last 2 weeks. Volume 25% lower on the pullback today. That's going to wrap it. As always, love to hear from you. Don at revereasset.com. Or if you're interested in becoming a client, email my partner, Dan Stewart, Dan at revereasset.com, or you can call 855-REAL-WEALTH. That's 855-732-5932. Remember, folks, it's not how much you make in the market, it's how much you can keep. We protect the downside first, and then we participate in the upside when the market improves. And it's a common sense approach to us. What other part of your life, when things are going south, do you not take corrective action? we think your portfolio shouldn't be any different. And with that, I'm going to wrap up Monday, January 30th. This is Don Vandenbord telling it like it is. Thanks for listening and have a great day.